Hi, in the previous module, we went through the classic concepts for accounting for inventory. In this module, we are going to examine some additional issues that arise. The first one of these is subsequent measure of inventory. Inventory is initially recorded as an asset at its historical cost. That inventory is then reported on the balance sheet at that cost. Now, keep in mind, you learned this from the earliest days of your accounting education, that an asset must not be reported on the balance sheet at an amount greater than the net cash it is expected to bring to the company. So if that cost is greater than the expected net selling price, we must write that inventory down. So keep in mind where we're at here. We're at the end of an accounting period and we still have these goods as inventory, but we expect, it's very possible, likely, that we will sell these items for something less than we paid for them. We're going to take a loss. And the accounting principles tend to account for losses as early as they can be anticipated. Hence, so what are we talking about here? We are talking about situations that maybe damage has happened to the inventory. Physical deterioration has happened. Obsolescence has happened. Changes in price levels. Or simply reduced demand for the product. All difficult circumstances for a company. Here's some examples. Unsold electronics items when the next generation is about to be released or has been released. Winter clothes in March or summer clothes in August and September. Again, these are inventory items that are still in inventory at those points in time. And if we're going to make a balance sheet, we have to assess whether we can sell them for at least the cost of the historical cost that they are currently recorded as an asset in our records at. GAAP requires that unsold inventory be evaluated at the end of every reporting period. If that expected selling price is less than cost, historical cost, we record an inventory write-down. To do so, we record an adjusting journal entry and post that adjusting journal entry, which reduces the reported amount of the inventory. We accomplish this by debiting cost of goods sold and crediting that particular inventory item. Now please note, if the write-down is material in amount, in other words, we're talking about a lot of inventory, the usual, and it is unusual in nature, we will record a loss rather than debiting cost of goods sold. So if the inventory, if it's a material amount and it's unusual in nature, record a loss rather than simply debiting inventory, where debiting inventory is plus expense minus stockholders' equity, whereas this is plus loss, and again, still minus stockholders' equity, but it places the write-down in a different place on the income statement because it is considered rather unusual. If it just happens because that's the way our business goes, we will record it as cost of goods sold. Okay, so that's the accounts that will be debited and credited. Of course, this is minus asset. Now, there are two approaches to inventory write-downs. The lower of cost or net realizable value, and you'll hear this referred to as NRV for short, or lower of cost or market, which is LOCOM. Sorry. I should have put lower of cost or net realizable value and lower of cost or market. So when are these two used? We use lower of cost or market if the company's cost flow assumption is LIFO, or if the inventory if the method they're using is the retail inventory method, which we used shorthand RIM when we learned about that method. All right, let's learn a little more about those two methods. LCNRV, lower of cost or net realizable value. So what companies apply LCNRV, lower cost or net realizable value? Remember from the last page, it's companies that use any inventory cost flow assumption other than LIFO or retail inventory method. Because if they use LIFO or the inventory or the retail inventory method, they use LOCOM, lower of cost or market. You'll also see it called LOCOM or LCM. All right. Let's see a few other questions about that. So that's what companies apply lower of cost or net realizable value, as opposed to what companies apply lower of cost or market. So what we're seeing here is the difference between market and net realizable value. Let's learn a little more about that. Lower of cost or net realizable value, we compare the inventory cost to the inventory net realizable value. And then, so this begs the question, a little nicer underline for you there in your notes. How is net realizable value determined? Net realizable value is the amount the company expects to realize from the sale of the inventory, the selling price, and specifically, and by the way, net of certain costs, and those are. So the key word up here, I should have the word net amount in there. Net realizable value is indeed the net amount the company expects to realize from the sale of the inventory. It's equal to the selling price, but then minus selling price minus cost of completion, disposal, and transportation. Cost of completion is any additional cost necessary to get the inventory ready for sale. Cost of disposal and transportation includes sales commissions and shipping. Okay? That's lower of cost or net realizable value in detail. Lower of cost or market. Again, who applies lower of cost or market? This is if they use LIFO or the retail inventory method. Market, with quotes, refers to the market price to replace the unit of inventory. Well, that's interesting. To replace the unit of inventory. All right. This is current replacement cost, is what you'll hear it called in the real world. It's the inventory's current replacement cost by purchase or reproduction. In other words, remanufacture, if we manufacture it. Special notes, though. So this is the rule, replacement cost. The current replacement cost by purchase or remanufacture, reproduction. Special notes. Replacement cost should not exceed net realizable value, which is the lower of cost or net realizable value minus the ceiling on the replacement market. The market should never be less than the net realizable value itself, less the profit margin. Okay, so these will be a lot. We're going to do a case on these rules, both of these methods, in the next video. And it's a lot easier to learn it in conjunction with numbers and facts. But here's a picture for you to begin to think about what's going on in lower of cost or market. The cost in lower of cost or market, the market rather, is the replacement cost. Okay, so for now, let's think of that as the rule, but it's going to have some caveats. Right? It's replacement cost. However, this replacement cost has a ceiling and a floor. And the ceiling is the net realizable value, and the floor is the gross profit, net realizable value less profit margin. So if the replacement cost is less than this amount, you'll use gross profit. If the replacement cost is greater than net realizable value, you'll use net realizable value. Otherwise, we're using replacement cost. Okay. I know that seems unnecessarily complex, and I may even say that, dare I say it, it is. But it's the rules. So let's now do a video, apply them, and learn it. To that end, please now work the next video, and then I will work it, and you can see my solution, which will hopefully agree with exactly what yours was. Indeed, we're going to do the same case under lower of cost or net realizable value and lower of cost or market. And of course, the way we're going to do that is assume one company is using FIFO, and then the second case study company is using one company is using FIFO, and then the second case study company is using LIFO. All right. Thank you for your attention. Again, if it seems a little complex, both reread the section in your book and also reread the notes after working diligently on the two following cases. Thank you for your attention.